After falling below Wall Street's earnings expectations in July, Tesla got a short-term boost. Moody's Investors Service recently raised the company's outlook from negative to stable, largely because Tesla met its production goals on the Model 3. But the ratings upgrade is being eclipsed by higher import tariffs in China. China's retaliatory tariffs on about $75 billion worth of goods take effect on September 1st and on December 15th. They apply to a wide range of products like clothing, chemicals, agricultural goods, and automobiles. As one of the major car companies building a significant number of vehicles in the U.S. for export to China, Tesla could be hit hard. China is a critical part of Tesla's long-term strategy, being Tesla's second biggest market in terms of revenue. The company touts itself as the next great growth company, betting that demand in China, now the world's largest electric car market, will rise significantly and eventually pay off. But the tariff hikes could hurt demand and Tesla's sales in China, since Tesla may be forced to raise prices.
It's really not a great time to be expanding a new business into China. Tensions are escalating. It's a very fluid situation with President Trump and President Xi. The trouble is, if you're planning a business, you need months and even years of lead time to do a proper expansion. And we don't have any clarity on what the next couple hours are going to look like.
To save costs and improve margins amid rising demand in China, Tesla borrowed $500 million to build a new car plant in Shanghai. The tariffs will come just as Tesla completes construction, with Model 3 production scheduled to start by the end of the year. During Tesla's second quarter earnings call in July, Tesla CEO Elon Musk continued to promote the company as a paragon of growth.
We expect growth to continue in the future at, for several years to come at the 50 to 100% level.
But Musk's enthusiasm doesn't match up with the market reality. Tesla's sales around the world, including China, are slowing, not growing. And U.S. sales are expected to be down for the year and fall short of the 17 million mark for the first time since 2014. And demand for Teslas is likely to slow, since U.S. federal tax credits, once as high as $7,500 for Tesla buyers, expire at the end of this year. And Tesla's debt means the company has less cash for responding to those pressures. The company has never turned a profit.
Revenue growth is the way to keep the story going for Tesla. And in the third quarter coming up, analysts expect sales to actually decline a little bit from a year earlier. Tesla needs to show that that slowdown is just a blip and that the future really is as bright as Elon Musk has claimed.
Another option is for Tesla to be less ambitious in terms of size and sales expectations. Tesla can thrive in the industry without dominating it.
There is a real viable business for Tesla in the long run, selling super expensive cars to select buyers, the way they started out, what got them their brand value in the first place. The trouble is that's a sustainable business, but it might not carry a big market value. Stock investors just won't be as interested in that as a mass market story.